Welcome to the Explainer, folks. Today, we're going to completely master two of the most powerful and honestly sometimes confusing statutory arts in the GST framework. I'm talking about tax deducted at source, TDS, and tax collected at source, TCS. Now, to make these complex rules crystal clear, we're going to take a little journey into the conceptual realm of taxia. Just imagine a diligent young student named Kaito sitting before the wise elder of the council. Kaito's mission? To learn exactly how to safeguard the kingdom's treasury using these two unique tax mechanisms. And through Kaito's training today, you are going to absolutely nail down Sections 51 and 52 of the CGST Act. Let's get into it. So you might be wondering, why do we even need these mechanisms in the first place? Well, the elder begins Kaito's training with a pretty profound piece of wisdom. These mechanisms are literally designed as powerful instruments to prevent tax evasion. Basically, they split the responsibility of tax collection between the deductor and the tax administrator. This guarantees a steady, reliable inflow of revenue for the government. But crucially, and this is the real genius of it, it creates a robust, inescapable audit trail, perfectly harmonizing the data that the supplier and the buyer submit on the GST portal. Okay, here is Kaito's training map for today. We'll start by mastering TDS under Section 51, then we'll uncover something called the no TDS illusion. After that, we'll navigate TCS under Section 52, crack the puzzle of calculating net value, and finally, we'll lock in the ultimate compliance deadline. Let's dive right into Part 1, mastering TDS under Section 51, which we're calling the golden grasp. Now, you should know that not just anyone gets to wield this golden grasp. Section 51 very strictly defines who is legally mandated to act as a deductor. This power is exclusively reserved for central or state government departments, local authorities, and governmental agencies. Plus, there's a list of specifically notified persons. This includes your public sector undertakings or PSUs and societies established by the government. Basically, if you aren't on the specific list, you generally don't have the power or the obligation to deduct TDS under GST. So, for those who do have the power, when does it actually activate? The elder reveals the magic threshold to Kaito, and it's a number you need to memorize: 2,50,000 rupees. The deductor is only required to withhold tax when the total value of taxable supply under a single contract exceeds this 250,000 rupee mark. Now, keep in mind, individual supplies might be smaller, but if the total contract value crosses that line, boom, the grasp tightens and TDS applies. But wait, here's a massive trap that so many people fall into. When you're calculating that value to see if you hit the threshold, the value of supply must strictly exclude tax and cess. When Kaito is checking a contract against that $250,000 limit, he has to look solely at the base value. To put that into perspective for the real world, let's say you have an invoice totaling 2.6 lakhs, but that includes $30,000 in GST. Well, your base value is actually just 2.3 lakhs, meaning no TDS is deducted. You didn't cross the threshold. Okay, so once the threshold is crossed and it is triggered, what's the actual damage? The standard rate of deduction is 1% under the CGST Act from the payment made to the supplier. Actually, scratch that. It's effectively 2% total because naturally there's a matching 1% under the SGST Act for intrastate supplies. If it's an interstate supply, it's just a straight 2% IGST. So it's a very precise standard slice taken right out of the payment. Moving right along to Part 2, the no TDS illusion, and how to navigate this tricky statutory trap. There's a vital exception tucked away in the proviso to Section 51(1), and it's a real jurisdictional blind spot. If the location of the supplier and the place of supplier are in one state, but the recipient is registered in a totally different state, the illusion triggers and absolutely zero tax is deducted. For example, say you're a supplier in State A, the place of supply is State A, but the government recipient buying from you is registered over in State B. No TDS. Why? Simply because the recipient in State B can't easily transfer or utilize the intrastate taxes of State A. It's a really smart exception when you think about it. All right, let's shift gears to Part 3, navigating TCS under Section 52. Welcome to the digital nexus. To wield Section 52, Kaito first has to understand who actually runs this digital space. Enter the Electronic Commerce Operator, or ECO. The elder defines an ECO as an operator, and importantly, they are not just an agent who is mandated to collect tax when they collect consideration on behalf of a supplier for taxable supplies made through their portal. Just think of the massive online marketplaces we all use every day. If they handle the customer's payment on behalf of a third-party seller, they are the ECO. Let's pause and compare these two mechanisms really quick just to prevent any cognitive overload. With TDS, the tax is deducted when a recipient makes a direct payment to a supplier. But with TCS, the tax is collected by the electronic commerce operator when they receive the payment from the customer on behalf of the supplier. One is a deduction from a direct government payment, and the other is a collection taken from a portal-facilitated transaction. Make sense? So, what's the exact rate levied inside this digital nexus? Section 52 requires the ECO to collect tax at a rate of 0.5% of the net value of interstate taxable supplies. If it happens to be an intrastate supply, that 0.5% is just split evenly down the middle. 0.25% for CGST and 0.25% for SGST. Sure, it's a smaller fraction than TDS, but when you apply that across the literally massive volume of e-commerce happening every second, it secures a vast amount of revenue. Which brings us to part 4, calculating the net value. This is where we solve the real puzzle. You see, net value of taxable supplies isn't just a casual phrase. It's a very specific, strict statutory term. The ECO has to look at the aggregate value of taxable supplies made by all registered persons through their platform in a given month. But they can't just stop there. They have to meticulously strip away a few specific elements to find the true base value for TCS. Here is Kaito's actionable 3-step formula, and I highly recommend taking notes here. Step 1. Start with the total aggregate taxable supplies made through the portal. Step 2. Immediately reduce that amount by the value of taxable supplies that were returned to the suppliers during that same month. Returns just don't count. Step 3. Strictly exclude any services notified under subsection 5 of section 9. These are specific services, like certain ride-sharing or food delivery apps, where the ECO is already legally liable to pay the full tax as if they were the supplier themselves. Collecting a separate TCS on top of that would be double counting. Apply these 3 steps, and you've got your true net value. All right, we've made it to part 5, the ultimate compliance deadline, the vow that binds everyone. If you remember nothing else from this explainer, cement this crucial number into your memory. The 10th. Whether you are dealing with the golden grasp of TDS under Section 51 or the digital nexus of TCS under Section 52, the deducted or collected amounts absolutely must be remitted to the government account by the 10th day of the succeeding month. Miss this deadline, and you are facing the immediate wrath of interest and penalties. But what's the reward for all this precise, timely compliance? Well, the Elder explains that once deposited, this money doesn't just vanish into a black hole. The tax that was deducted or collected seamlessly shows up in the supplier's electronic cash ledger. The supplier can then utilize this balance to actually discharge their own liabilities. They can use it to pay their final output tax, cover interest, or settle up other fees. It's a perfectly closed, highly efficient loop. As our explainer draws to a close today, Kaito finally stands ready. But the Elder poses one last test to ensure he's truly mastered these arts. And you know what? I am passing this challenge directly on to you. Think carefully about everything we've unpacked today. If a supplier sells a product through an e-commerce platform and that platform handles the customer's payment, are we dealing with the government's golden grasp of TDS or the portal rules of TCS? And once you figure that out, by exactly what day of the following month must that money be deposited to the government? I'll leave you with that provocative thought to test your newfound mastery of sections 51 and 52. Keep learning, keep analyzing, and we will see you in the next